Hi everyone, this is Aleena Kareem. I am your ACCA subject expert for SBR exam. Today we are going to discuss in this topic explainer video, share-based payments including deferred tax implications. Share-based payments is a very important area of your SBR exam. So in this topic explainer video, we are going to discuss the key areas that you need to cover to properly learn about how this standard is applied in the practical field also and how is it tested in the exam as well. We are going to look at the study hub also, which is going to tell you how you can cover the contents from there, and we are also going to look at some of the practice questions. However, please do keep this in mind that this video is not going to completely cover the teaching of the IFRS 2 or share-based payment transactions. Neither is it a debrief of a question video. So this is going to give you a comprehensive overview of what you need to cover and what are the commonly tested areas. So let's begin with our discussion. When we talk about share-based payment, so the name of the standard is share-based payment. The standard that we deal with is IFRS 2. So the name of IFRS 2 is share-based payment. And I always tell my students that do keep this in mind, that the name of the standard in itself is completely self-explanatory. It is telling you that there is a payment which is going to happen, but that payment is going to be based on shares. Now, it does come into our mind that how come a payment is based on shares? Shares is something else. And whose shares are we talking about? So this is what we are going to look in this standard, that this standard particularly highlights that the financial reporting of an entity, how does it take place when it undertakes a share-based payment transaction? Because before this standard also, there were payments being made which were share-based, but it was not clear how they are going to be accounted for. Some companies even thought they do not need to account for this, which was completely wrong. Now, over here, we are going to talk about share-based payments when the company receives goods and services in exchange for, number one, its own equity instruments. So this is the first most important point of this discussion, that when we talk about a share-based payment, we are not talking about any other company's shares. We're talking about the company's own shares, the company's own equity instruments. We use the word equity instruments because this may be directly shares, this may be share options, and these may be share appreciation rights. So all of these come under the category of equity instruments. Then, second very interesting thing is that the name of the standard is share-based payment. So based, what does that stand for? That either we are going to make a payment directly by giving our own company's equity instruments to someone, or we are going to pay cash, but the amount of that cash is going to be based on the value of some equity instrument of our own company. So this is very important to know, that when you are dealing with IFRS 2, basically you are talking about your company's own equity instruments and how the calculation of the amount is done based on the value of those equity instruments, or we give the equity instruments directly. Now the question over here comes that if I'm giving against a good or service my company's share, how do I account for it in my own financial statements? Because I'm not issuing it for cash. When we issue our shares or any other equity instrument for cash, we are very clear about how we are going to account for it. So we have a cash inflow, we have an equity instrument which is going out, or a valuation which is based on it. But over here, we are directly giving equity instruments against a good or service, or we are going to make a payment based on the valuation of these instruments. So we'll see how this is going to be applicable and how we are going to account for it. So very important part of any standard is the scope. I told you earlier in the video that we're going to discuss how this standard is tested in the exam also. this is a short video, so we don't have time to cover in detail all the accounting treatments, but I'm going to give you a complete overview of what are the key areas that you need to cover. And a very important area for any standard, including this one, is the scope. Because in your exam, when you get a scenario, the first thing you need to identify is that which standard is applicable on it. And for that purpose, you immediately need to connect it with the scope of that standard. This accounting treatment comes under the scope of which standard. See, recognition and measurement, what is going to be the value, what is going to be the double entry, this all comes later on. The important part is, first of all, identifying which standard is particularly going to be applicable over here. So scope is the main area in which we identify that which standard is going to be applicable. So this standard says that the accounting treatment covered in this particular standard is for equity settled share-based payment transactions. So number one thing, just like we discussed, we get goods or services, and against that, we say that we are going to give our company's own equity instruments. So when we commit that you provide a service to me or you send some goods to me and I'm going to give you my equity instrument, then IFRS 2 is going to be applicable. Next thing, if your exam scenario says that you got goods or services and against that you said that I'm going to make a cash payment, but the value of that cash payment is going to be based on the value of my equity instruments, at the value at which maybe they're trading in the market. So this also is covered in IFRS 2. And the third very interesting point is the choice of settlement. When we talk about the choice of settlement, then in this case, the question is who has the choice and what exactly is the choice? So the standard says that choice of settlement means that I purchase some goods from you or I take a service from you and we have a choice. Either I can make it an equity settled transaction or a cash settled transaction. So the third point mainly covers point number 1 and 2, and there is a choice between those two. So even when there is a choice, the accounting treatment comes under this particular standard. Now over here, who has the choice? There are two scenarios. The standard says either we can have the choice as to whether we want to make an equity settled transaction, so we directly want to give equity instruments, or we want to give cash, which is equivalent to the value of those equity instruments. So in this case, there are two scenarios. Either the company itself is going to have the choice, or the supplier of goods or services is going to have the choice. Please do keep this in mind that over here, when we talk about the choice, you have to very clearly identify this in your exam question, because your question is going to tell you that there was a choice of settlement. However, we need to identify who has that choice. If the entity has the choice, the accounting treatment is going to be different. If the supplier has the choice, the accounting treatment is going to be different. Which is why I always tell my students that please remember, your exam question is your best friend in your exam. Spend time reading the question carefully and identifying which standard and then which part of the standard is applicable over here. Rest is then on your memory as to what the accounting treatment was, and you have to apply it over here. So in your exam questions, be very careful as to what is the overall scenario, whether it is an equity settled transaction or a share-based payment, and if there is a choice of settlement, who has the choice. Equally important is that there are some transactions which seem to be share-based payment transactions, but they are not in the scope of IFRS 2. Again, why is this important? Because we have to identify in the exam question which standard is applicable on which scenario, and then we have to do the accounting treatment accordingly. So over here, number one type of transactions which are outside the scope of IFRS 2 are issue of shares to owners in their capacity of being an owner. So they are not supplying a good or let's suppose any services. Rather, we are issuing shares, maybe a right issue or a bonus issue, to the shareholders of the company. Now quickly think, which standard is going to be applicable if IFRS 2 is not going to be applied? Yes, it is going to be IS 32, because we are talking about financial instruments and we are talking about the issuance of our own equity shares. Then when we talk about the exchange of shares in a business combination, remember in consolidation, we talk about that while we are purchasing the company, there are different ways in which we can pay the consideration. So it can be a cash consideration, or there can be a share for share exchange, any such thing. And then we use it in the goodwill calculation. So all of this comes under the scope of IFRS 3, and these share issuances are not covered in the scope of IFRS 2. And lastly, when we talk about the contracts that may or will be settled net in company's shares, then also the net settlement, as you know, comes under financial instruments, and these are not covered under IFRS 2. So very importantly, in your scenario, first of all, always read the question carefully and identify whether it comes under this standard or not. Now that you're very clear about what transactions come under IFRS 2, let's have a quick overview of what are the main points that can be tested in your exam. So, to understand that, it is very important to first see how ACCA describes the syllabus linkages and how our syllabus guide tells us what is going to be tested in the exam. So, please remember that when we talk about the overall syllabus linkages, we have discussed the equity recognition in the past exam papers also. So in your financial accounting exam, in your financial reporting exam, we have talked about issuance of shares. However, this is actually the first time in SBR that we are talking about a share-based payment transaction. So this is something that you have to identify and find out the differences also. Then, your share-based payment transactions, they can come up in individual and consolidated financial statements. So they can be tested in any part of the exam, and they are part of both the types of financial statements. Also, if we talk about a direct linkage of another exam in which this knowledge can be tested, that is your Advanced Audit and Assurance exam. So in that also, the SBR standards are tested. So this topic is not only important for this particular paper, it has linkages with the future papers also, and it can be tested anywhere. So it is linked to all individual and consolidated financial statements. When we see the syllabus reference, so the ACCA syllabus, it talks about share-based payment, and it says that what can be tested, evaluate and apply the recognition and measurement of share-based payment transactions. So this is the exact line that I've picked up from the syllabus, where it says that evaluate and apply. And you see there is a 3 written in the brackets. That's the level of testing that can be done. So here we are at the strategic professional level. You've passed your all the previous exams. You're done with your skills level. Over here, everything is about synthesis and evaluation. So the examiner is not just straightforward going to say, oh, tell me what a share-based payment transaction is. Rather, they're going to give you scenarios in which you have to evaluate situations and you have to apply the standard. For this purpose, you need to know when and how a share-based payment is going to be accounted for. And the when part comes with the recognition criteria. So the recognition of this standard is that you pass the double entry when goods or services are received. So when you talk about the goods, they are easier to identify and they are received all at once. So in case of goods, we say that as soon as the control is transferred, we recognize the goods immediately. However, when we talk about the services, there might be 2 scenarios. Services, maybe we have already received them, or we are going to receive them over a point in time or over a certain period of time rather. So when you have received the goods or services, not just the contract, when you have actually received them, then the entry is passed. And then a corresponding entry has to be passed, which is either going to be an increase in equity or a liability, or there might be an increase in both. We'll have a quick look at how this happens. So when we talk about the measurement criteria, so in case of measurement, we need to identify, we saw the double entry, but at what value are we going to pass this double entry? So here comes the measurement criteria for equity settled share-based payment transactions. In case of equity settled share-based payment transactions, we are going to see, first of all, how the goods are recognized. So in case of measurement, the standard says that the best part is that in case of goods, you can identify the fair value of goods. So when you identify the fair value of goods, you recognize the value as per the fair value. However, if we are talking about services, again, services may have been already received or they are going to be received over a period of time. I'm going to discuss vesting word in a minute, so I'm going to leave it for now. Just think about a time period that services are going to be received over a time. So in that case, normally it is tricky to identify the value of services. Now the standard says that if you do not have the value of goods or services, a very fair value of goods or services available directly, then you need to identify the value of the equity instruments that you're going to issue and pass the double entry accordingly. We are going to see the valuation also shortly, but one thing, please keep this in mind. Here, first of all, in measurement, we are talking about equity settled share-based payment transactions. And one rule that is fixed across financial accounting is that equity once recognized is not remeasured. So over here, when we talk about the issuance of equity instruments, we take their fair value at the grant date. Grant date is the date at which the equity instruments are issued or the relevant commitment is made. Now, to see the calculation, I'll move to Study Hub, but before that, I quickly want to give an overview of all types of measurement, and then we'll move to Study Hub to see how the valuation can actually be done. Because it's not just straightforward when we said it is going to happen over a period of time. We also need to identify how do we then recognize the amount over a period of time. If we are providing share options or share appreciation rights against services of employees, then someone may leave. What do we do in that case? So all of that we are going to come back in a minute. Meanwhile, if we talk about measurement of the cash settled share-based payment transactions, over here the remaining rules are the same. But the difference is that the liability is remeasured at fair value at every reporting date. See, liability is remeasured. Equity is not remeasured. So in case of liability, you have to do an additional point. And that is that at the end of every year, at every reporting date, you have to identify the fair value of the equity instrument. And then you need to do the calculation accordingly. So as I said, we're going to come to calculation in a minute, but identify this difference first. That in equity, you take the fair value of the equity instrument at the grant date, whereas in case of cash settled share-based payment transactions, you take the fair value of the equity instrument at every reporting date and do the calculation. How? We are going to see shortly. Also, we talked about these critical terms, which are vesting period, vesting conditions. Now, what is the vesting period? Vesting means in which some conditions are attached and there is a time period. So let's suppose today I make a commitment that I'm going to issue certain equity instruments after my employees provide me 3 years of services. So today, when I am making this commitment, this is my grant date, right? The word is grant date. And then I'm making a condition that an employee needs to stay with me in my business for 3 years, and then he or she is going to get the share options or the share appreciation rights or any kind of equity instrument. So that 3-year time period is called vesting period, and the condition that I have attached is the vesting condition. Now, vesting conditions can be of two types, which are market-based conditions and non-market-based conditions. Market-based conditions are the ones which are related to the share prices. Non-market-based conditions are the ones which, just like I gave you an example, that an employee needs to stay in my business for 3 years. So these are the two types of conditions. Remember, market-based conditions are already incorporated in the fair value of equity instruments at the grant date, whereas for non-market-based vesting conditions, we need to evaluate at every reporting date. Now, in case of choice of settlement, which is a mix of the both of two, we said that either the entity has the choice or the counterparty has the choice. So these are the two choices. But before covering these, because these are slightly tricky, I want to show you the study hub and how the measurements that we just covered, they are going to be there in the study hub. So let's switch my screen to the study hub. Here we are in the SBR study hub. As you can see, you have the chapters on the left side. You have flashcards for the syllabus, quizzes, practice questions. In here, when we go to the chapter number 13, it is dealing with IFRS 2 share-based payment. So all of the details from the overall objective to definitions to the measurement criteria, everything is covered comprehensively over here with short examples. I'm going to focus on the measurement part, starting off with the equity settled transactions and their measurement criteria. First of all, it talks about the theory of how recognition is going to be done, as we have already covered it. So I'll try to cover a short question with you over here. So initially, the definitions like grant date and the measurement criteria with respect to even vesting conditions is mentioned. Then when we move to the next tab, we have the details of vesting conditions and a very good question available over here. Remember, this question is for equity settled share-based payment transactions. Now, here we have a particular date on 1st January. A company has granted 500 share options. Please always note in the question very carefully what is the number of share options, as our working is going to be dependent on it. Then how many people are going to get these options? 10 senior managers. Whenever you have the word options, it means it is an equity settled transaction. Now, the condition is that they remain employed for the company for 3 years to 31st December 20X9. The fair value of the option on the grant date has been mentioned. In case of equity settled share-based payment transactions, we use the fair value of option at the grant date to do our calculation. And as equity is not remeasured, it is going to remain at the fair value of option at the grant date. Only the estimations with respect to the number of people, time, etc., they are going to change. Now, the question is telling us over here that when we'll reach 31st December 20X9, we will expect that one person is going to leave in the remaining vesting period. Then when we'll reach 31st December 20X8, we will expect that one further person is going to leave. And in the last year, our expectation is that no one is going to leave. Remember, this estimation is at the reporting date, which is 31st December 20X7. Now, actual leavers till 31st December 20X8 were one person, and till 31st December 20X9 also, it was just one person. Now we have to do the working accordingly. Let's start with the working. At 31st December 20X7, our expectation was that one person is going to leave. Now, out of 10, one person is going to leave. So we take the number of people as 9. Then we take the number of share options per person, that is 500, and the fair value of option at the grant date. Because it is an equity settled transaction, we are going to use the fair value of the option at the grant date. This gives us an overall expense of 18,900, which is for 3 years. Now, out of these 3 years, we are standing at the end of year 1. So we apportion this figure 1/3 to get the expense to be recognized at the end of year 1. We debit the expense and credit the equity by this amount, which is 6,300. Every year we are going to use this formula, number of options per person, number of persons, and multiplied by the fair value of option at the grant date. Now, when we come to the year 2, one person has left and we feel that one more person is going to leave. At this point, we are trying to calculate the expense which we are going to charge in the year 2. Now, 10 people started off, one person has left, one is expected to leave, so minus 2, we have 8 people. It is as per our estimate that 8 people are going to get the benefit of these share options. We multiplied this with number of share options per person multiplied by the fair value of option at the grant date. This gives us the accumulated expense for 3 years, which comes out to be 16,800. Now, because we are at the end of year 2 only, we apportion this by 2 by 3 to get the overall expense for the 2 years. Now, out of this expense, remember, we are at the end of year 2. However, we already recognized some of the expense in year 1. We are going to subtract this 6,300 from 11,200 and the balancing figure is going to be charged as an expense. This is going to happen in all share option questions. So you first calculate the accumulated expense and then you subtract from it the expense which has already been recognized till date. Then we come to the end of the vesting period. By this time, we are sure that only one person has left. So we come back to the calculation of 9 persons, 500 share options per person multiplied by fair value of options at the grant date. This figure is still the same because it is an equity settled share-based payment transaction. Now we recognize the overall expense that is there. This is the accumulated expense of 3 years. From this, we subtract the expense which has already been recognized till date and the balancing figure is charged as an expense and as an equity. So this is how we are going to do the calculation and charge the expense every year. This was for equity settled share-based payment transaction. Now let's quickly take a look as to how cash settled share-based payment transactions are going to look like. When your question talks about share appreciation rights, it means that you are supposed to do the calculation for cash settled share-based payment transaction. In this case also, over here you can read the detail of the measurement criteria, how it is done. We have touched upon it in my video already. Let's see the question which we have at hand. Now in here, on 1st January 2006, PEPCO granted 60 share appreciation rights. As I mentioned, as soon as you see the word share appreciation rights, get to know that we are talking about cash settled share-based payment transactions. To each of its 200 employees on the condition that the employees work for PEPCO until 31st December 2007. Then, during 2006, 12 employees leave and PEPCO estimates that further 15 are going to leave during 2007. During 2007, 14 employees leave. Then on 31st December 2007, 61 employees exercise their SARs. Another 77 employees exercise their SARs 1 year later, which is at 31st December 2008. And the remaining do it on 31st December 2009. Now, because we are dealing with cash settled share-based payment transactions, here the situation is different. Here we have to calculate the value of our liability based on the fair value of the share appreciation rights at every year end. So let's begin with this. We have the fair values available and we have the intrinsic values also available. Let's start with the working. In the first year, we see how many were the total employees, how many are expected to leave. Then the number of share appreciation rights that every person has. We have picked this up from the question. The expectation is also mentioned in the question. Remember, in your SBR exam, you will be given all the estimations. So you don't have to worry about calculating these estimates in the exam. Now, in the year 1, we have calculated the number of people multiplied by number of share appreciation rights that everyone has, SARs, multiplied by the fair value of the SAR at the reporting date. And because this is for 2 years and we are currently at the end of first year, we apportion this and recognize the liability and the related expense. Now, in case of SARs, you are going to recognize liability because this is a cash settled share-based payment transaction. Then at the end of 20X7, we are talking about 200 number of SARs. Out of this now, when we talk about the estimation, we have the estimate that 12 employees leave and further 15 are going to leave in the 20X7. This was for the first year. Here we are saying that further 14 employees leave. So 12 had already left and 14 further left. Therefore, 26 employees have left in total. Out of this, 61 have exercised their options at the reporting date. Now, if we talk about the fair value of the SAR that is available in the question, we pick that up and we calculate the overall liability. Now, the method is the same, that you calculate the cumulative liability first, and from this you subtract the expense which has been previously recognized. So we get the final expense. We talk about the exercised SARs also. Now, exercised SARs, you have the number available of people, you have the number of SARs available, and you have the intrinsic value available. You calculate the expense accordingly. Going forward also, at every year end, you are going to calculate the number of unexercised SARs, and you're going to calculate the liability accordingly, and the exercised SARs, they are going to be calculated at the intrinsic value. So every year your liability is going to decrease and it is going to convert into your exercised options, for which you are going to recognize the relevant expense. Here you have the double entries also, which are going to be passed for the recognition of cash settled share-based payment transactions. This is all with our discussion with respect to Study Hub for the cash settled share-based payment transactions and equity settled share-based payment transactions. Now let's move back to the presentation and continue with the learning of concepts. Okay, so once we are done with these, now we come to the choice of settlement. In choice of settlement, remember, entity may have the choice. If this is the case in the question, you have to see what is the intention of management and what has been the past practice, and you need to recognize the transaction accordingly. However, if the counterparty has the choice, the party which is supplying the goods or services, then in that case, you need to recognize this like a compound instrument, like we covered in IFRS 9. So you have to identify the present value of the liability. The remaining is going to be the equity component. At the time of settlement, the counterparty is going to actually tell you whether they want to take cash or they want to have the equity, and you're going to recognize them accordingly. So this treatment is just like the treatment of compound instruments, like we talk about the convertible loan in case of IFRS 9. Now, when we talk about the exam application, then your IFRS 2 can be tested in question number 1 also. And normally it comes up as a treatment where they say that parent company has this share-based payment commitment within the scenario. So you have to recognize it just like an individual company. Also, this can come up as a part in any other part of the question. It can come up as ethics. Very common testing is that they would say that the company is not recognizing the share-based payment because they feel that no expense is being made, no cash is going out of our business. We are going to give our own shares, so we don't need to recognize this. So it can be a part of ethics. It can be a part of your stakeholder analysis where you have to tell the shareholders that yes, these shares are being issued and we didn't offer them first to you. What was the reason for it? Then, when we talk about modification, a few other items that can come up in your exam are modification, repricing, cancellation, and settlements. So what are these? Modification means that we are making a change in the terms and conditions of the commitment that we have made. Then there may be a repricing. So the amount that we committed, we initially said that we are going to give you our share options at $1. Now we are changing that and we are saying that we are going to give it to you, let's suppose, at $2. So, or maybe $0.5. So there can be a repricing, there can be a cancellation of the program that was offered, and there might be settlements. In all of these cases, you have to see whether there is an increase in the liability or there is a decrease in the liability, or there is an increase in expense or a decrease in expense, and we need to recognize it accordingly. Please do practice exam questions also related to this, because modifications, etc. are also something that has come up in our exam. Now, one more point that I want to touch upon before ending this video is the deferred tax implications. This is a very important part. See, deferred tax is covered under IAS 12. However, deferred tax is applied on different accounting treatments. So here we are going to discuss IFRS 2 because this is a very interesting accounting treatment that we come across. Now, tax allowance may be provided for some share-based payment transactions. It totally depends on the legislation of the country in which we are operating. It leads to deductible temporary difference. Why? Because the expense is being charged in a certain accounting period, and normally the tax benefit is provided when the final settlement is done. Now, in this case, the difference between tax base of the employee services received to date and the carrying amount of the share-based payment, they are compared. Normally, the carrying amount of the share-based payment is 0. So, when we compare it with the tax base, the deductible temporary difference arises, which leads to the recognition of a deferred tax asset. So this is one of the few scenarios in which commonly the deferred tax asset arises, and then you have to apply all the rules of IAS 12 to see whether your company is actually eligible to recognize the deferred tax asset or not. So this is a very interesting mix of IFRS 2 and IAS 12. Now, just let's quickly take a look at the past exam questions. Now, let's quickly take a look at the past exam questions. I just picked up one question, and in that, please remember, first of all, the things that you have to remember is read the requirement of the question very carefully. What are they asking for? There was an exam question in which they were asking for a working for 2 years. A lot of students miss that part out. At times, the students do extra working. You have to see what the examiner is asking for. Is he asking for the impact on P&L? Is he asking for the impact on equity? Is he or she asking for any other kind of impact that is going to happen on the stakeholders or the ethical impact? Please read the requirement very carefully. Then extract the data accordingly. As I said, identify whether it is a cash settled transaction, equity settled transaction. In fact, first of all, see whether it comes in the scope of IFRS 2 or not. Then, once that is done, identify the relevant part of the standard. Give your logic. Why is this expense being recognized? This is a very important part that I wanted to cover at this point. That in case of IFRS 2, a lot of people feel that if we have committed to employees that we are going to give them equity options at the end of 3 years. Why are we recognizing the expense now? Because we have studied accounting principles. We've talked about matching concept. The employee is providing the service in this accounting period. So the relevant share-based payment impact should also be recognized in the current accounting period. So at every point in time when you are answering your questions, bring in the relevant accounting principles. Always remember the logic of the working. Why is the expense increasing? Why is the equity increasing? Why is the asset being recognized? So all of that. And then always take a look at the marking scheme to identify how many valid, well-developed points are you supposed to make. And then, as I said, conceptual understanding that how I am going to apply the standard to this particular scenario and explain it to your examiner. Now, just a quick example of a question. This question, I have taken it up again from the practice questions of your study hub, ACCA study hub. You can access it over there also. But just for your understanding, I've taken the screenshots and put them over here. That this one asks for define what are cash and equity settled transaction, what is the basis of measurement. This was comprehensively covering. Then if you see, the examiner gave 2 schemes. So one scheme was talking about granting of share options. Then the other one is talking about granting of the share appreciation rights. So one is a cash settled transaction, the other is an equity settled transaction. Same thing, estimate at the end of each year, how many options or SARs are actually going to be vested. If there is a change, apply it prospectively, calculate the cumulative amount, subtract the expense that has already been recognized, and then recognize it. And once the actual vesting takes place, the exercising of the options takes place, then start decreasing the liability accordingly. So over here also, if you see, the question said, calculate the expense to profit or loss for the year ended 30th September 2018. So over here, you have to identify the date, what is the expense that is being charged to profit or loss, and then what amount is going to be shown in the statement of financial position. And where is it going to be shown? Is it whether this is a liability or this is an equity? How is that going to be accounted for? So these were the main areas of your share-based payment transactions. Please cover them comprehensively and do a lot of practice. This is my mantra. I use it maybe 1,000 times in one semester or one session, but practice, practice, and practice. Go through these accounting treatments and apply them to past exam questions. Practice whether it is written, and especially when it is time managed. That is very important to see that you are actually able to read, identify, and write the answer within time. And then after that, reading the solution, this is a very important pattern that you have to follow. Mark yourself as well. That's the best way to identify that if you are the exam marker, would you give yourself a mark for this? This is all from my side. Thank you so much for joining today, and please do cover this area comprehensively as it has been repeatedly tested in the past exam papers. There is a very interesting article also on the ACCA website on the same topic. Please do take a look at that as well. Thank you. I hope you found the video useful.